What's up, everybody? This is Sunko, and today is 2022, February 21st. Tonight is Monday night. I'm doing YouTube live right after developing some software and workout. Uh, let's look at the articles, stock articles, and see what we can focus on. Okay. Hmm. Okay. What do we have tonight? First off, Yahoo Finance. Market beats. Okay, Zach's investments. Okay, what do we have? Sign in. Oh, no, 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 no. No, 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 no. Okay. 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 Uh, 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 Tonight is again reddish, 6.86% down by Upstart Holdings. Let's look at the related articles and see what authors think. Okay, four no-brainer growth stocks to buy amid the tech wreck. The tech sell-off has created a perfect opportunity to buy these game-changing stocks at a discount. Since the market bottomed out during the Great Recession nearly 13 years ago, growth stocks have been virtually unstoppable. Historically low lending rates and dovish monetary policy have rolled out the red carpet for fast-paced companies to borrow cheaply in order to hire, acquire, and innovate. But over the past couple of months, the market's leading sector, technology, has turned into its biggest drag. Whereas tech stocks have single-handedly pulled the market to new heights. At times over the past decade, they are now causing something of a tech wreck. Yet, if there's good news here, it's that every single stock market crash and correction throughout history has represented an opportunity to buy high quality, innovative businesses at a discount. The following four growth stocks are perfect examples of no brainer buys amid the tech Carnegie. CrowdStrike Holdings. It's also one of the stocks that I've spent my money on, and now it's like 20% minus in my case. Hmm. One of the smartest ways to take advantage of this pervasive tech sell-off is to buy industry leaders that offer clear-cut competitive advantage. One such example is cybersecurity stock CrowdStrike Holdings. On a broader basis, cybersecurity has evolved into a basic necessity service. No matter the size of a business or how well the US economy and stock market are performing, hackers and robots don't take a day off from trying to steal enterprise and consumer data. With businesses shifting a lot of their data into the cloud in the wake of the pandemic, the responsibility of protecting information is falling onto third party providers like CrowdStrike more than ever before. That's right. The not so secret source that makes CrowdStrike take is its Falcon security platform. Falcon was built in the cloud and it relies on artificial intelligence to grow more effective at recognizing and responding to potential threats over time. While CrowdStrike solutions aren't the cheapest, the Spur security provided by its platform has made it a popular end user protection solution. Not surprisingly, its customer retention rate has been hovering around 98% for over 2 years. The company's operating results also show that it's having no issue courting new clients. In less than 5 years, CrowdStrike's subscriber count has catapulted from 450 to 14,687. Hmm. Perhaps even more impressive, 68% of its existing subscribers have purchased 4 or more cloud module subscriptions. That's up from 9% less than 5 years ago. As existing clients spend more, CrowdStrike's adjusted subscription gross margin creeps ever close to 80%. Offshore holdings. Let's look at offshore holdings. I know CrowdStrike Holdings is one of the stock which needs attention here. Let's look at offshore holdings. Another absolute no-brainer growth stocks to buy during this tech wreck is cloud-based lending platform Upstart Holdings. Shares of Upstart are 65% below their 52-week high as of February 17. While I'm reading this article, I'm going to look at the chart at the same time and see chart pattern so that I can really find out if it's taking the form of a bottom out or not, right? CrowdStrike Holdings, not so much. It went all the way up to 284, and now it's down to 164. Offshore Holdings is also one of the Upstart Holdings. Okay. Wow. Another absolute brainer growth stock to buy during this tech wreck is cloud-based lending platform Upstart Holdings. Shares of Upstart are 65% below their 52-week high as of February 17. Upstart has been hammered for an assortment of reasons. To begin with, the Federal Reserve expected to begin raising interest rates in March. When rates rise, multiples for growth stocks typically contract. Also, since Upstart's platform is involved in the lending business, there's concern that higher lending rates could reduce demand at the bank level for loans. So, however, neither of these worries can dent Upstart's growth trajectory or long-term strategy. This is a company that's leaning on artificial intelligence, machine learning to vet loan applicants quickly and accurately. It's not only saving financial institutions money, but it's democratizing the loan process by helping folks who might not otherwise qualify for a loan. The number that continually stands out in Upstart's operating results is the high percentage of revenue it collects in the form of bank fees and service revenue. During the fourth quarter, 94% of its revenue came from fees and service. This means Upstart has no direct credit exposure and will therefore not be hurt by potentially higher loan delinquencies in a rising rate environment. Okay, there's another reason that I have to spend my money on in this stock. Upstart Holdings, basically like a lending platform, cloud-based lending platform. Mm. Something that's gotta do with mm, what is it? Uh, housing market, right? And CrowdStrike Holdings has got to do with security. You know, as most companies, since Corona occur, people are more likely to load their data up on the platform, so up on the cloud, and security. The importance of security has been increased because of that. Uh, mm, the more data goes up on the platform, the more people are aware of its importance. Because once it's hacked, a lot of data can be revealed, which means um many people's private information can be possibly misused, and at the end, it could potentially harm their own account, or security, right? So the importance of its security is going up currently. That's why CrowdStrike Holdings is really important one. Mm. And next one we have is Neo. Electric vehicle manufacturer Neo is a third no-brainer growth stock that's been put on the sale rack as a result of the tech wreck. Okay, do we have Neo? Do we have Neo? Um, no, it's not on my list. So it's going to be up on. It's going to be on my watch list. Okay. Aside from fears of multiple compression in growth stocks, Aside from fears of multiple compression in growth stocks, NEO has been weighed down by semiconductor chip shortages, which have affected the entire auto industry. The shortages have halted the company's aggressive production ramp up at a time when EV market share is up for grabs. Hmm, Okay. On the other hand, it's an undeniable truth that most countries will be pushing green energy solutions for decades to come, encouraging consumers and businesses to go green by purchasing EVs will be on that agenda. This vehicle replacement cycle is going to last decades and afford auto stocks a period of sustained above average growth. Okay, what's been impressive about NEO is the company's ramp up amid the supply chain issues. In November and December, NEO was pacing an annual run rate of around 130,000 EVs by year's end. Management anticipates the company will have an annual run rate closer to 600,000 EVs. Okay, furthermore, NEO's management team made the genius move of introducing its battery as a service. Program in August 2020, the BAS program allows buyers to charge, swap, and upgrade their batteries. It also reduces the initial purchase price of an EV. In return, buyers pay NEO a monthly fee for this service. NEO has effectively traded some lower margin, near-term revenue for higher margin, long-term revenue that will boost customer loyalty. Palantir Technologies, a fourth no-brainer growth stocks to buy in the wake of massive sell-off in tech stocks is data mining. Mm. Specialist Palantir Technologies, data mining. Okay, what we just briefly go over was the company named Neo, and Neo does electric vehicle. Neo is an electrical vehicle manufacturer, and because of shortage of semiconductor chip, its price has gone down recently, but its value has never changed, has never been changed, has never changed. So, mm, and they got a lot of good strategy in terms of battery wise. So, uh, Palantir Technology is a what is it? Is a data mining specialist. Not to sound like a broken record, but multiple compression has been a big theme behind the recent tech wreck. Less than 13 months ago, Palantir's market cap briefly soared above $80 billion, which is a rich valuation for a company that reported about $1.5 billion in full year sales in 2021. As of February 17, Palantir had lost about three quarters of its value from its all time high. However, patience should pay off handsomely for Palantir's investors, given that no other company does what it does at scale. No other company does what it does at scale. Palantir has two operating platforms. Okay, let's look at the chart and see its price. Hmm. Mm, it's not really, it doesn't seem like it's really affected by Corona. But let's see. Palantir has two operating platforms, each with a very specific target. Gotham service federal agencies, while Foundry is focused on enterprise clients. Hmm. For the past couple of years, Gotham has been the company's core growth driver. Large multi-year contracts signed with the U.S. government have sustained the company sales growth above 30%. So, the U.S. government has helped them a lot uh, to have growth, right? But looking ahead, Foundry is a Palantir's golden ticket. Uh, Not only can Foundry help businesses streamline their operations by simplifying mountains of data, but it has global appeal. That's not the case with Gotham, which will be limited in its global appeal by security concerns. In other words, Gotham is not something a Palantir's management team would allow China's government to use. Its recent pullback a buying opportunity for long-term investors. Okay, Neo is the one that's put on my list today. Hmm. Uh, and let's look at some of the other issues here. Neo also went down by 6%. Marca de Libre also went down 8%. Hmm. Good one, good one. Okay. Let's look at this article. Okay, in this article, we discuss the top 10 stocks to invest in. According to Carl Anderson's Marshall Partners, you can skip our detailed analysis of Anderson's history, investment philosophy. Unity Software, Slay Limited, Spotify Technology, Farfetch Limited, and Kazoo Group. Unity Software. Last NV. Wix.com, Warca de Libre, Shopify, AppLovin Corporation, California mobile technology company, which through its subsidiaries Max, App Discovery, and Sport Labs, all developers market, monetize, analyze, and publish their apps. AppLovin Corporation. I don't know. App Loving Corporation. Unity Software C Limited is a Singaporean conglomerate founded in 2009. Its famous subsidiaries include C Money, Shopee, and Garena. The company also owns Lion City Sailors FC, a soccer club that plays in Singapore Premier League. The investment management firm Tao Value mentioned C Limited in its second quarter investor letter. Here's what it said. C continued to execute above expectation. The gaming business continued strong momentum, recording bookings of $1.1 billion, growing 170%. The major franchise Free Fire showed no sign of slowing down in established ASEAN Latin market and received positive reception from new markets. Like US on e-commerce side, Shopee demonstrated early success in expanding to Brazil by adopting a low price category and gamification strategy. For 2021, Shopee is now top downloaded e-commerce app in Brazil. Shopee and C Limited. C Limited. Okay. Okay, Spotify Technology is an online music streaming service. On November 24, benchmark analyst Matthew Harrigan initiated coverage on Spotify Technology with a $300 price target and buy rating on its shares. According to the company, continues to innovate larger hyperscale tech competitors. According to Insider Monkey's databases, Kathy Woods-Art Investment Management holds the most significant stake in Spotify Technology, with 4.6 million shares worth $1 billion. It is followed by Tiger Global Management LLC with $597.5 million worth of shares. In their third quarter 2021 investor letter, here are the contents of the letter. Is a leading digital music service available in 178 international markets, offering on-demand audio streaming through paid premium subscriptions as well as a free ad-supported model. Shares were down as engagement declined. While economies reopened and pandemic restrictions were lifted. We continue to view Spotify as a long-term winner in music streaming with potential to go from 158 million paying subscribers today to over 250 million in 4 years. Spotify. It's also 4% down. It's not on my list, so okay. Farfetch Limited is an online luxury fashion goods company headquartered in London. The company operates in several countries across the globe through online retail. However, it also has in-store operations in the UK, USA, France, and Japan. Out of 167 hedge funds from the Insider Market database, 63 hedge funds held stakes. Kazoo Group is a London-based online car retailer founded in 2018. Online car retailer. The company acts as a subsidiary of Kazoo Holdings Limited. According to third quarter 13F fillings. App Loving Corporation. Shopify. Canadian e-commerce platform. As of March 2021, 1.7 million businesses use the company's platform across 175 countries. Shopify. Wow. E-commerce company. 73 of them held stakes in Shopify Inc. in the third quarter of 2021 compared to 85 in the previous quarter, showing a decline in the hedge fund sentiment. Here's what the investment management firm Clearbridge Investment said about Shopify. Companies that have become go-to platforms for small and medium-sized businesses engaged in e-commerce and social media marketing rebounded strongly in the quarter after being caught in the sell-off among high multiple growth names since Vaccine Monday. These and the portfolio's other disruptors had thrived through the first part of the pandemic, leading us to trim positions into strength and reallocate cash into more attractively priced evolving opportunities and steady compounders that have been overly punished by lockdowns and a drop in economic activity. Hmm. I'm going to list up beautiful charts. One that looks stunning, you know. Unity Software, formerly known as Over the Edge Entertainment, is a California-based video game software development company founded in 2004. The company acquired the Wellington-based digital visual effects company Weta Digital for $1.63 billion in November 2021 in a cash and shares deal. Quite bullish for hedge funds in the third quarter of 2021. Spotify technology, and what else do we have? Farfetched. Well, Marco Libre is Latin America's most popular e-commerce and online auctions company. The company's headquartered in Argentina and incorporated in the USA. Hmm. The company has approximately 175 million users and operates in 19 countries across Latin America. The analysts have been quite optimistic about Marco Libre recently. On November 5th, Barclays analyst Trevor Young raised the company's price target of $2,200 from $2,100. 8% down tonight. Marco Libre. Holds large stake in Marco Libre. Was mentioned by LRT Capital Management in its third quarter 2021 investor letter. Shipping and payments company is now trading at a very attractive valuation. Its lowest PS ratio ever. The concerns here have to do with the recession in Brazil and slowing economic growth throughout the region. Wix.com is an Israel company that provides cloud-based web development services from 19 locations across the world. The company has also owned the famous online art community website DeviantArt since 2017. It was acquired for $36 million. At the end of the third quarter of 2021, underperformance of investments in IT, consumer discretionary, and financials detracted the most from relative relative results. Wix.com provides software that helps micro businesses build and maintain their websites. Its stock was the largest detractor from performance after the company's quarterly results showed a modest year-over-year slowdown in new customer additions, driven primarily by the waning of pandemic-driven trends. Weeks.com. Wow, fantastic. Elastic share prices are up more than threefold since our first purchase of Elastic software. The company continues to report best-in-class net revenue retention of 130%. With recent acquisitions, um, they are continuing their expansion into security. This is the company with the highest product velocity and largest addressable markets in our portfolio. With a massive base of customers using freemium open source products, there are further hunting grounds for growth. Dutch company that provides enterprise search, observability, security, logging, and data analysis. Hmm. Moderna, Market Libre, PayPal Holdings. There's also another fintech stock that Wall Street really likes, PayPal Holdings. Consensus price, PayPal Holdings. The consensus price target for the stock reflects an 80% upside potential. Investors haven't been loving PayPal lately, though its shares have plunged 66% from last year's high, even with the company posting nearly $4.2 billion in profits for 2021. One key reason behind this decline is that PayPal expects its user growth will slow. However, it's important to understand the context. PayPal is intentionally shifting its focus from increasing the number of users to boosting revenue per active account. If the company's efforts are successful, this should lead to even higher profit over the coming years. Like Moderna and Marco Libre, PayPal should have massive long-term growth prospects. The company directly benefits from the increased adoption of e-commerce. It's rolling out QR code functionality, an increasing number of retailers that bodes well for future brick-and-mortar e-commerce profits as well. War shares mixed as investors eyes Ukraine inflation. 13% down by Fubo TV. Airbnb 4% down, 8% down, Mercado Libre 6% down, Upstart Holdings. Upstart Holdings and PayPal Holdings, Pout Interactive. Neo and Meta Platforms. Skills. We got Teladoc Health, Fever International. Wow. Is the stock market open to here? Are the hours for President's Day 2022? Kathy Woods R continues its buying spree. Exodus from bond funds is mitigating the stock market swarm. Too strong buy stocks are too cheap to ignore. Stocks turn lower on doubts for U.S. Russia's summit markets wrap. Tech investors suffering the second stock rout of the COVID pandemic. Get far worse. Traders look past Ukraine angst to load up on Here's when the stock market is closed this year. Surge shares buyback offers support to spotting markets. Salesforce. Adobe. DocuSign. Snowflake. Roblox. Metaport. Qualcomm. JP Morgan now expects 9 straight Fed rate increases until March 2023. Asian markets mostly lower as investors rarely eye Ukraine crisis. Danger zone for Italian debt, the next focus for bond traders. Keeps faith in Bitcoin. Investment enters mainstream as CSOP's exchange traded fund debuts in Hong Kong to pick winners in next generation wealth. Great traders are born in bear markets. Here are 5 keys to follow. Quitting can be contagious at a company. Here's how to stop it. Okay. It's buying spree. R purchased 694,584 shares of Roku, worth $71.8 million as of Friday's close. Roku. C and Robles Friday, but Art also shares of Palantir. Star investor Kathy Wood, CEO of Art Investment Management, keeps on catching the falling knives. She has insisted in recent weeks that the fall of young technology stocks has simply created buying opportunities, and Art has been buying up plenty. On Friday, its exchange-traded funds picked up shares of streaming platform Roku, video meetings platform Zoom Video Communications, a digital entertainment e-commerce company C, an online video game platform Roblox, among other companies. Or purchased Roku. Explain its thinking about Roku, C, and Roblox in a written commentary. As for Roku, the company said in its fourth quarter earnings report that active accounts increased to more than 60 million, surpassing the number of video subscribers combined at all the cable companies in the U.S. are said. Although U.S. consumers spend 45% of their viewing hours on streaming TV today, advertising on streaming TV accounts for only 18% of total TV advertising budgets. A gap we expect to close, or said. Roku is the leading TV operating systems in the US and is beginning to scale internationally. When it comes to C, the stock stumbled last week after India banned one of the company's video games. While regulatory uncertainties surge C's growth potential in India, we believe the company could continue to take share in Southeast Asia and expand across Latin America and Europe. Focused on buying. Porsche Group, Renewable Energy Group. The first stock we're looking at is Porsche Group, an online service company offering software and platforms that connect homeowners with the service they need to maintain and improve their properties. Porsche Group. These include home improvement and warranty, contracting, moving, and home inspection. Taken together, Porsche can connect customers with service providers in every segment of the $500 billion annual home improvement market. In December of 2020, through a SPAC transaction, and shares saw volatile 2021 before falling sharply from their November peak into the beginning of this year. The stock is down 68% from that peak. Second, stocks rout. The COVID pandemic and Wall Street think it could get far worse. Nail the forecast. So far in 2022, once high-flying tech stocks are taking it on the chin, with the Nasdaq down 14% year to date and down 16% since hitting an all-time high in mid-November just before the Omicron wave arrived to better develop the world. To be sure, very few stock picking pros are calling this the bottom. While there are plenty of reasonably valued and profitable companies in the market, there are many more dangerously overvalued and unprofitable companies whose stocks could fall as much further, and some even to zero. David Tranier, CEO of Nashville-based investment research firm New Constructs, tells Fortune. Zoom, PayPal, and the companies you would find in Cathie Wood's Art Innovation ETF, all of which soared during the latter half of 2020. PayPal and the companies you'd find in Cathie Wood's Art Innovation ETF, all of which soared during the latter half of 2020, as if it were the plague. Once investors got a whiff that top line growth for those companies was slowing, they started to cash out. Meta and Freefall. Netflix. Let's look at the chart on Netflix and see if it's opportunity. 4% up. Oh, but still it's okay. Netflix, Meta. Faith in Bitcoin. Great traders are born in bear market. Here are 5 keys to follow. Okay, this is gonna be my last article, and after doing this, I'll be calling it a day. Okay. There's an old market saying that everyone is a genius in a bull market. When the market is in a strong uptrend, then throwing money at random stocks can be a very effective strategy. It doesn't take much skill or wisdom when everything is running higher. When you are making money, there is an inclination to believe that it is due to your genius rather than good luck. It is when the market gets difficult that real skill is necessary. It is when the market is when the market is at its worst that good traders will produce substantial outperformance. Sometimes not losing money produces the best relative performance. The best hedge funds tend to tag lagging strong market uptrends, but then they produce outsized relative gains when the goings get tough. The impact of here are the keys to being a great trader in bear market. Patience. The biggest mistake the traders make in the bull market is that they are impatient. They identify stock that they want to own and then average down the position too bad and too fast. When the trade doesn't work, they sell at the exact wrong time and take a big loss. This happens over and over and is probably the source of the biggest losses for most traders. The best way to develop patience is to move incrementally, make partial buys and sells, and constantly adjust position size so that you don't feel trapped. a supply of buying power. Your view of market conditions is largely a function of your buying power. If you are fully invested in a downtrend, it is misery. But if you have substantial buying power, then you tend to see opportunities and not losses. It is particularly important to understand that you can create buying power anytime you want by simply selling positions. Too often, traders are hung up on recognizing a loss. They don't want to admit a mistake, so they hold on to something, and they greatly impairs flexibility. Being able to sell a poor stock in a bull market is one of the hardest things for many traders to do. But once you do it, you tend to feel significant relief and are suddenly free to pursue better opportunities. Familiarity. A bull market is a good time to become familiar with good stocks. Persistence, a thesis, and a plan. Make sure you have a clear thesis and plan for every trade you're making and admit when you're wrong or when conditions change. Why do you think that this stock is going to be a big winner? What is unique about the situation that will eventually lead to a strong move? The most important aspect of dealing with a bad market is persistence. You must keep slogging away day after day. If you enter a trade and it doesn't work as planned, then take the loss and try again. There's no way to know when your timing will be right. You just have to keep trying and keep losses small while you wait it out. A big part of persistence is cultivating a positive mindset. I know without a doubt that I will find great trades in this lousy market if I just keep slowing away. If you believe that, then it will provide all the motivation you need. Okay. Okay, this is it. And I'll be seeing you guys tomorrow, okay? Bye bye.